Good morning. How are you?
David, it's a pleasure to meet you. Thank you so much for coming in today.
Of
Uh,
course.
I've been talking about your service and how StockCharts has really upped their game in the last couple of years. You have some of the legendary guys that provide content for you, and you have television broadcasts that you do. So you're good on both sides of the mic, huh? You could go you could go either way on a mic.
I'll do what I can. Yeah.
We're bi-microphones. Anyway, so there is a share screen option here, David. It's a
Yep.
little green box if you want to show your setup or website, and there it goes. Okay, beautiful. All right, so David, it's the first time I've met you,
Yeah.
and I know you've been in the industry for a long time. Can you tell us just a little bit about your journey into it and how it began for you?
Absolutely. And not surprisingly, as a professional technical analyst, I have a chart to answer the question. Um,
Okay.
so I've been in
Oh,
the
look at
industry
that.
since
All right.
mid 2000, June of 2000. And to
Okay.
walk you quickly for your viewers that aren't familiar with my work, I
Okay.
started at Bloomberg in New York. I was there from 2000 to 2008. And that's when I learned technical analysis. I had actually studied music and psychology as an undergrad at Ohio State, which is a
Oh, you,
non-traditional
uh,
training for the financial industry.
you
But
Buckeye.
if you think about it, it actually turned out to be remarkably good for technical analysis because one, it's a study of psychology, a study of sentiment. And when I learned there was a technique that helped you get inside other investors' heads, I was totally hooked. And then,
Okay.
the first time I learned about Fibonacci numbers was in music because the whole
Right.
musical scale, the octave, all of that is based off of Fibonacci patterns and
Right.
Fibonacci relationships. So when I learned that you could apply that in investing as well, same thing. It just sort of made sense to me.
Yeah. So the road that you took was really preparing you for this. And, I've talked to a lot of musicians that, love trading because of that. Everything
Sure.
is math, isn't it? Whoever created this universe, there's some type of natural order. And today someone was asking, is, a head and shoulders pattern a natural phenomenon? And yeah, patterns that repeat definitely give us some insights into how to approach a market, define our risk, look for targets. So, uh, what's the second destination there? That green
Yeah. So after being at
Fidelity.
Bloomberg, yeah, that was Fidelity. So I was Bloomberg
Okay.
until 2008, and I ran the technical, a team of product specialists that would travel around North and South America. And then I was hired by Fidelity in 2008 to run their technical research department up in Boston. So I was part of the asset management division. We ran all the equity mutual funds, and I ran a team of altogether about 20 analysts that would give buy and sell recommendations to the equity portfolio managers based purely on technical inputs.
What was it like at Fidelity in March of 2009?
There's a lot of red on a lot of monitors. I will tell you that those first, and it really started earlier when the first big sell-offs in 2008. I remember a couple of my analysts and I just standing in my office looking at our monitors and just watching things accelerate, and just no one was saying anything. We're just kind of staring at these things going down,
Yeah.
10% at a clip, which was outrageously unique.
Yeah. Yeah.
It was fascinating, but I tell you what, I grew a lot as an investor during that 2009 to 2011 period. That was a fantastic experience, and I'm glad it's behind me now.
Yeah. Yeah. Do you agree, David, that we learn the most from our mistakes?
I would say every really good investor I've ever met has a story of climactic loss from earlier in their career. It's a formative
Isn't that something?
experience where they
Yeah.
learn how to deal with adversity. And, for me, I mean, 9/11 living in New York was probably my first big experience with that and just the whole
Yeah.
cyclical bear market. But that period in 2008 to 2010 was
Bobby Axelrod was shorting transports and airlines that day,
that's right. That's right.
right? Okay.
Yeah. Yeah. Yeah.
I know. That must have been. Were you in New York when it happened?
Yeah, so we actually lived in Princeton, New Jersey. So my wife
Oh,
was in the city. I was actually working out of our Princeton office. So,
yeah.
but yeah, lost colleagues and a lot of clients. It was
Yeah.
not fun.
Yeah. Okay. So after Fidelity, um,
Yeah, so this is the
What's
CMT
that?
Association, which was called the
Oh,
MTA. So that's the Professional Organization for Technical Analysis. And I was
right.
president of the organization from 2010 to 2014, which was a really, really cool experience. And it was dealing with a lot of volunteers from the global organizations, about 5,000 members now around the world. But I tell you what, that's where I grew an appreciation for the U.S. industry and the U.S. financial markets versus all the other places that people are investing. So spent a lot of time talking with members in India and Europe and developing Asia and Latin America. And, it was really helpful to sort of think about how all these markets are interrelated.
And plus all the people you got to know. I'm a big believer in intelligence gathering, David.
Yeah.
I always do my own thing, but there are people whose work I respect. We have kind of a team. We have a team concept here, and people use different disciplines. Elliott harmonics. I use some J.R. Hill stuff. So it really helps, since we only have two eyes, to be collaborating with people that can see things that might point your eye towards something you didn't see on your own.
That's right. That's right. And I think, and again, I've always told people it's great to learn lessons from others, and especially, the best thing you can do is invest, is try something and see how it goes, and you will lose money and you will learn a great deal from that. But it's great to get help from others, especially when there aren't a lot of zeros attached to your account yet, because that's when you can really start to, get some good routines under your feet, get some good sense of how others have tried to win this game, and then try to emulate that as much as you can.
Okay, so now we move on to the airplane.
Here we go. So I launched my own research firm. I left Fidelity end of 2016. I launched my own sort of research and consulting firm called Sierra Alpha Research end of 2017. And that's that icon there. So I spent most of my time with that, working with institutional investors, but also a lot of financial advisors, and working with them to address behavioral challenges in their investment process. So we talk a lot about how they make decisions and all the behavioral baggage that can get in the way of good
It's all in
decision.
our heads.
It really is. So getting out of our own way, having an honest conversation
Yes.
with ourselves ends up being really, really key, I think,
Yeah.
to trading, to investing. And so that I've enjoyed working, one-on-one coaching a lot of advisors, talking through some of those challenges.
I love that. Do you advise people to journal?
100%. And I do two things. The one is a morning journal. So every morning, 3 pages that you fill with whatever is in your head. And I would encourage your viewers that are trading and have a beginning to the day. Start with getting all of the crap out of your head. Write it down and just get it out of there. And you will find you have a much clearer perspective with what you're trying to accomplish. You'll be much more focused. And then also having a good trading
NLP. Neuro linguistic programming. If you write something down, it has more impact on you.
Makes a huge difference, right? And just thinking about it is a start, but really writing it down physically, it connects to your brain in a meaningful way, and it starts to be more real. That's right.
I used to update my charts by hand in the old days.
I met with Ralph Acampora outside of Minneapolis a couple of months ago. We talked a lot about, he was, lamenting that most technical analysts, me included, did not learn to chart by hand. I think, I'm just, 43, and I was learning all.
Don't rub it in, David. Go ahead, buddy.
But I think, I think we missed something by not charting things by hand. And Bruce Kamick, who taught technical analysis at Baruch College in New York for years and years, swore by he would make all the students draw out charts by hand. And I totally agree. I think that I later, when I was learning point and figure charting, kept a point and figure book for a couple of years, and that I internalized it so much more because of that.
Yeah, that was, a lot of guys on the floor had clerks that would do the X's and O's for them while they were trading. So here we are today.
And then here we are. Yeah, so I joined StockCharts.com about 3 months ago. That involved a relocation to the Seattle area. So I'm in the Pacific Northwest now, which has been great. We really enjoyed it. And StockCharts is a really cool place. It's been around for about 20 years and was started by Chip Anderson, who was a former Microsoft engineer and literally bought the domain and started building a charting program from scratch. And we've sort of grown it from there. So I joined as chief market strategist, and our goal, as you kind of alluded to, and thanks for the introduction, kind of thinking about all the different ways we can add value for technically oriented traders and investors. And we think about it in terms of the tools you have, the education to understand the product or understand the tools better, and then commentary, learning from those that have come before us, guys like John Murphy and Martin Pring and others.
Yeah, exactly. I know those are names that take me back to, well, not my beginning, but maybe middle. Anyway, David, so interesting journey. And, with what's happening here, maybe we could talk a little bit. It looks like you prepared a PowerPoint for us. Is that it? Or you want
all sorts of things
ad lib?
For you. Yeah.
I'm kind of interested in, we're looking at the end of the year.
Yep.
And that, worst December last year since 1929. And the market has been, a wonderful place to be for the full year.
Sure.
Looking ahead into 2020, you're looking for a continuation of this bull market. Could we have a 10% correction if, perhaps like this trade deal that everyone's celebrating, as you can see, like they're hoping to sign a deal while the Chinese say they're still negotiating a deal.
Right.
What's your view going into 2020?
So
in the stretch market. Go ahead.
I was listening to Steve's comments before, which overall I thought were very, very interesting, and especially in terms of the U.S.-China deal and how to make sense of it. I would start by saying hope is never a good investment strategy. So let's stay grounded in what we're seeing in the trends and the price, and price is the most important thing to pay attention to. I would firmly say to everyone, because that's what tells you how people are interpreting what's going on. Last week, I spent the week in New York and had a morning on the floor of the New York Stock Exchange with one of the floor governors. We had a great morning kind of talking about his role. And it was that morning, and it was Thursday morning when the Trump tweet came out first thing saying, China deal's done. It's happening soon.
Can I ask you one question? Who does he govern? The floor is a bowling alley.
Yeah.
Right, every floor.
He governs the shrinking number of gainfully employed market.
Got the easiest job in the city.
So it's funny. I was very.
He manages a CNBC crew.
No, I was wondering exactly what it was. What was interesting is actually there's an IPO going on for Bill.com that morning, and what I did not realize was how much the market makers are intimately involved in the IPO process. That is still a very human-driven, manual. Process dealing with supply and demand real time and setting the opening price, figuring out how it's going to come out. That there's a point where I think they still have a very valuable role. A lot of what would have been manual years ago, as you know, is all electronic. It's all automated now.
Yeah, well, we might miss those bodies in a time if market structure and the machines are running things. We might miss having a backstop of a market maker. What do you think?
It's funny. I'm asked a lot because I talk a lot about behavioral finance and investing, and I get a lot of questions about man versus machine and how things are automated. And I think you're right. I would say two things about that. Number one, there's always these unintended consequences when things are over automated, and having, what he basically does is things are going, but he has a set of alerts. And when something would happen that's sort of outside of a normal acceptable range, then he jumps in to address it. So he's still, watching and waiting to come in. And there are times when he has to step in. And in particular, at the open and at the close is when he still is involved every day, because there's a lot of order imbalances and things like that. And he has to set the prices. So I think there is still certainly a role for humans there. And then the second thing is when, if and when the market meaningfully corrects, which is going to happen at some point, you're not going to want your computer to tell you the market's correcting. You just lost X amount of dollars, no problem. You want to sit down with a person and have a conversation with someone who can put themselves in your shoes. And so I think the roles in the financial industry are going to have to evolve. That makes sense. But there are still going to be places where humans are very, very necessary. And I think, people that want to be successful in the industry going forward, I would be gravitating towards those types of roles that are going to keep adding value.
Okay. And don't you think that the experiences of 2000 and 2008, where people were just balanced a certain percentage in bonds, equities, cash, whatever, and they felt like they were okay, and they lived through huge drawdowns, they finally said to themselves, as they look at their salesmen a number of wirehouses, is that if anyone's going to lose my money from now on, it's going to be me. And that's why the big boom towards self-directed trading and trading education happened.
That's exactly right. Yeah, there's an empowerment that comes with investing, and especially with technical analysis. If you think about it, I mean, technical analysis was created, I mean, centuries ago, if you go back to candlesticks analysis. But in terms of modern technical analysis, about 100 years ago plus, Charles Dow and the ideas of trends and all that. And it was
had lunch with the guy.
I'm sure you grew up together. I wasn't going to ask that. Yeah, right. But I mean, remember that this was before fundamental analysis was a thing, right? Companies didn't really have to report anything meaningfully in the early 1900s. Technical analysis actually predates it. And it was, I think, designed as a way for self-directed investors to have any sort of advantage in the market and compete against the robber barons who were sort of driving the financial industry. And as the markets have evolved and fundamental analysis has come on and all sorts of, you know, computer power and everything, things have sort of fluctuated. But at the end of the day, the ability of an individual investor and a self-directed trader to use price action to understand what's happening and have an advantage over others is, I would say, resonates now more than ever. So I think it's a really, I think the ability of charts to add value has not waned in one bit. What concerns me, though, asking about, you know, the market going into next year, this is looking at the S&P 500 now, going back to sort of the end of 2009. And what concerns me, you asked about sort of a market outlook. I mean, I think overall we're holding up just fine. And as long as the trend continues of higher highs and higher lows, the trend is undeniably positive. That is fact. That's not opinion. So I'm happy to remain, you know, constructive on the markets until that picture changes. But what concerns me is that any investor that started investing in the last 10 years, which is a growing cohort of investors that now are starting to manage some real money because they're in their 30s, this is all they've known, is a chart that goes from the lower left to the upper right, and it just keeps continuing higher. And it's similar to the fact that bonds in a secular bull market for 30 plus years, no one knew any different. No one really saw what happens when interest rates start going up, or what happens when bonds aren't a savings account. They actually can lose value sometimes. And so what concerns me is if and when we do have a meaningful rollover in stocks, which I think will come for sure at some point, I think a lot of people will be unprepared for what that actually feels like, because we've forgotten some of those lessons from 15 years ago. It's just been too long.
Where do you stand on the historical levels we're at on, say, the stock versus commodity ratio? Because some commodity markets are starting to percolate a little bit. Precious metals had a good year.
Yeah, so this is a view that and what I'm showing you here, just so you know, I sort of, you know, this time of morning is when I usually get up and do what I call the morning coffee routine. And I start with a weekly chart of the S&P 500, and I just go down through every set of charts that are really interesting to me. And I get a sense of where things are at. Then I go into the office and sort of get ready to go with the day. And so this is the point where I would hit intermarket analysis, which is what you sort of alluded to, and thinking about, you know, at this point, I've sort of internalized what I see with stocks and stocks overall, just in a secular bull market, in a cyclical bull market, tactically looking overextended, I would argue. And the fact that the S&P is overbought here again suggests a little bit. I don't feel like...
You know, David, I knew some wave guys, and, you know, I used to do this on FX Street, and I'm talking about years ago.
Yeah.
That threw out, and we were a lot lower then, had a 3,200 target. That, you know, is currently manifesting in here.
That's right.
And, you know, I'm not an elitician, but, you know, it's stuck in my head, 3,200, and here we are. So, you know, I was just wondering if there was anything significant that you see at these levels with your discipline.
Yeah, so not necessarily. And I would say I thought a lot more about wave patterns in my Bloomberg days when I was working with hedge funds, because they would be focused a lot more on price levels and anticipating inflection points. My time at Fidelity probably skewed me much more toward trend following, because, you know, if you're a money manager and the market hits 3,200, that doesn't mean a ton if the stocks are still going up. You have to own them just for client's sake. I mean, you have to be where things are working. And so you're much better off following trends and anticipating trends, but really making sure you're there. So at this point, I mean, it's more of a long and strong environment. And I feel like the market's sort of innocent until proven guilty. Until you get some sort of indication that things are reversing, you still have to assume that there's strength in stocks. I think For me though, it's less the level, but I think how the price is actually going to evolve over the next couple months. We're in that seasonally strongest part of the year, sort of November to April. Stocks tend to do well, but I would say when you look at history, those are median level, right? That's the median return tends to be positive, and the average return tends to be positive as well.
So,
but that doesn't mean that it could be up just a little bit. It doesn't have to be up 20% over that 6-month period. So I think there could be a scenario here where stocks just don't go down meaningfully, but they don't go up meaningfully. And it's sort of that vicious third direction, which is more of a choppy digestion of all of these gains.
Yeah.
Steve was mentioning earlier just about the trade deal and what's actually priced in. I think that's what hit me when I was on the floor last Thursday and that tweet came out and the guy next to me said, well, that's it. It's priced in now. That he said it's done. It is now priced in. So what else is going to drive things higher from here? And I think there might be something there. At some point, there's either a manifestation of some of these rumors that we've been told, or there's frustration. And it feels more like we're going to have the latter instead of the former. I think that's when you get some pullbacts of substance here.
Okay, well, I see you have RSI on your charts, and I've renamed it to the real simple implicator. Implicator is not a word, but it implies things to me. That's the point of it. And you use RSI, and I'm wondering if this divergence that we're seeing here on a daily chart,
yes.
Means anything to you. It's almost we had two equal, but 71 is not such a great reading. We're not confirming, and to me that's at least lighten up on long signal. I'm wondering if you have it up there, if you use it.
I totally agree. And it is, if there's one indicator that I would use beyond just price and moving averages, kind of overlay type of stuff, RSI would be it. So I think it's a great way of standardizing price movements and understanding what the thing usually does and what it's doing right now. And are those in agreement or not? And what you're seeing here with not just the S&P 500, but with Apple, with Disney, with the XLV, the healthcare sector, they're all having
non-confirmations, huh?
All non-confirmations. So you have this,
okay.
The higher highs in price, the lower peak in RSI. And, I would say technically it's probably confirmed if we come out of this overbought region. And when we do, all of a sudden it feels very similar to July, where you had a very similar pattern of higher highs, a lower peak. Now, again, the primary trend remained positive. Overall, we continued, but this is a move I think people are probably not excited to feel. And it's going to be, because we've been in such a strong market, it feels a lot worse than it really will be. And I think a lot of people need to be sort of ready with how to deal with that potential downside.
Okay. Could I ask you what your views are on what's been happening in the overnight Fed funds market and repo market? At first we were told it was just corporate tax pressures. The Fed has really had to pump a lot of money in there. There's people talking about another squeeze towards year end of rolling over paper. Do you think this is technical, or could it be a canary?
Well, so that, and again, what concerns me, and I think what should concern many, is it's a huge unknown. And I bucket what you just described along with the impact of dark pools and high frequency trading as phenomena that we know are happening, but in terms of how much they're really impacting things day to day is an unknown. And an unknown for me doesn't feel bullish. An unknown, that uncertainty feels more bearish than bullish to me. So there's no doubt there's QE that's happening. There's artificial ways that markets are being held up. I think that is probably pretty safe to agree on, but the extent to which that is happening and the extent to which that would prevent a meaningful decline is what's really unknown. And again, we won't really know until it happens. But what I will say is, regardless of what you just described, I think the fear that will be palpable when markets do start to correct a little bit, and when things start to break down and a portfolio that has continued to grow meaningfully starts to shrink meaningfully, fear all of a sudden manifests very, very quickly, and it feeds back on itself. And I think that could overwhelm any of the artificial support that we might have seen on the market so far. I could be totally wrong, but for me, and maybe it's because I started in 2000, and so the beginning of my career was dealing with a raging bull market that completely unwound.
Post-traumatic stress.
It may be. I don't know if I'll ever get over it, but I know when the market gets new highs, I get very skeptical. And that served me very well in 2007 when I said, this is a top, this is happening, and I was very well equipped for it. It did not serve me well in 2013 when I said this is a top, and it completely blew through it and went higher. But I'm seeing conditions now that are similar to that euphoria that we've seen. And it's in so many ways. It's also, the IPO, the whole, the WeWork phenomena, all of these things that have happened that feel very late 90s to me. And I think you could draw a lot of parallels between where we're at and sort of like the 98, 99 period. So the challenge, I think, a lot of maybe your viewers, if they're more short-term oriented, I always think there are a lot of career busting moves that can happen between this moment and when a meaningful correction could happen. So I think you have to stay diligent and you have to be following price action and see what's actually happening day to day, week to week. But overall, that's what I feel. I feel like we've extended to the point, and with the divergences you're saying, it doesn't feel like the time when new money necessarily makes a ton of sense in equities. I feel like holding positions that you have, I could totally see that because the trend remains positive. But for me, I'm looking for ways to diversify away from that. You mentioned commodities. And again, I think I'm always looking for themes that people are unprepared for or unexperienced with. And a situation where things like gold and oil start to do very, very well in a way that outpaces equities even would be an unusual environment that people are not really ready for.
Yeah, or sugar, or almost any commodity markets.
Absolutely.
So does currency, the value of the dollar, do you pay attention to it? Does it play into your analysis of how you look at the world? Strong dollar, weak dollar?
Absolutely. And for me, when I'm thinking of the dollar chart, it's a couple things. Number one is the relationship of the dollar to stocks. I mean, obviously, our company's StockCharts, and we focus on equities. But in the course of being a good equity investor, I would argue you need to be aware of all these different assets and how they relate to your equity positions. So for me, the dollar has two key takeaways. One is just the impact on the overall equity markets, maybe three. The second would be sort of small cap versus large cap and what you might expect there. And then the third one, which I think might be really important here, is the relative performance of non-US stocks versus US stocks. So, what we've seen with the dollar, looking at the last year and a half or so, is we've had this corrective pattern. We had it at the end of December, sort of this meaningful pullback, and then a resolution higher. We had the same thing over the summer, a breakdown of the 200-day, but it reverses right back. We had sort of this similar pattern at the time. I wrote a note to customers saying, this is a very similar look, but if this doesn't play out the same way, I think that's going to be a very different environment that we need to be ready for. And what happened is we sort of failed. We had a lower high for the first time after that pattern. And now we've broken down through the 200-day. I'd argue this is sort of a dead cat bounce of sorts. And I think we might have further downside. What tends to happen in that environment is non-US stocks tend to outperform US stocks on a relative basis. And that has not been the case for a number of years now. And so there are ways, obviously, to look at that. One of the ratios I would look at is US versus non-US stocks. I'll quickly go through, my ratio there. You can see how that looks. To growth value, emerging markets, US versus the world. So this is the US SPY versus ACWI, All Country World Index. So US stocks have been outperforming consistently. We've not really outperformed meaningfully in the last 4 or 5 months. It's sort of been sideways. And we potentially have sort of this double topping pattern, and we're just starting to see a turn down. If the dollar continues to weaken, you would assume that would continue to go lower. And I think a lot of equity investors in particular have sort of written off non-US stocks because they just haven't gotten paid to own them for a long time. But if they
they want to own the best dirty shirts, that's been programmed into them, right? I just have one more area, and then we'll wrap it. You have a view on yields?
Yeah, absolutely. So going back to this, I think with bonds, it's a really key ratio, and the main ratio I would look at is the stock versus bond ratio, and it essentially shows for an asset allocator where should you be tilted, and this is kind of how I'm seeing that. It's undeniably been tilting towards stocks over bonds, and so if this ratio is going up, it's favoring the SPY. If it's going down, it's favoring the TLT, and it's just a ratio of the two, and you can see this cyclical pattern that's happened over the last 12 months. And we've been on this sort of extended positive leg. So I think what I'm thinking when I'm looking at interest rates is if you see limited upside in equities, do you see more upside in something like bonds? The problem that I've seen is we're sort of in this consolidation pattern, I would argue.
Like a triangle.
Until the price breaks above that trend line, this is on the TLT. So
right.
an inverted yield. Until we break above there, which would be around 140 for now, bonds still look weaker rather than stronger. But it's certainly potentially a higher low we're putting in here. I think it's very actionable here.
So, David, what a great example of what kind of content people could find on your site. You want to show it? Show like the homepage of your website and what kind of offers?
Of course. I would encourage your co-host Steve to check out StockCharts.com, of course.
Yeah, Steve, that's your homework assignment.
Who mentioned he sadly has never checked it out. Here's your invitation, Steve.
Yeah.
StockCharts.com, it's a fantastic platform. And again, the goal is looking at the markets using technical analysis, but also I think, we feel having education to understand the tools better. So we have a whole chart school platform, and then also having experts sort of sharing their wisdom. Those are the three that are most important. So check it out.
And also you have a show, something about a bar, the last bar?
The final bar. So it's on
the final bar. Boy, that sounds sad.
Host the closing bell show on StockCharts TV every weekday, 4:00 Eastern. So it's very technically oriented. 30 minutes of looking at the short-term trends, how they connect to the long-term picture.
Okay.
So,
All right. Well, really, there are so many pearls during this interview that we could probably string a necklace for Mrs. Cleaver. So I really appreciate meeting you, David. Anyone that I interview ends up being called my trading warrior brother. Hope you accept it, and hope you have a Merry Christmas and continued success with StockCharts.com. And it was really nice talking to you today.
Appreciate it, Dale. Yeah, a pleasure to spend some time with you. Happy holidays to you and everyone, all right?
All right. Thank you, everyone. That's David Keller, and you can find him at StockCharts.com. And we're wrapping up the meeting. We'll see everyone tomorrow. Good hunting. Adios. Oh, yeah. Don't just count your pips. Count your blessings. See you later.